Welcome back to Golden Rule Radio, where today we are going to talk about the metals market as always, and we're going to talk about the bond market, China, some world events, and usually we talk a lot about the dollar, the Fed, interest rates. Those all affect the metals market. And so, what has happened with the Fed? What's happened with interest rates? We've talked about that in the last year in this program, about the last few years of the interest rate hikes. So the last interest rate hike here in December 2017, what's occurred since then, Tori?
Well, Robert, we're actually looking at our fourth straight climb in the precious metals since a rate hike. And I think what the media either isn't reporting or doesn't even realize is, guess what, guys? Gold is beating everything since the Fed raised rates. It's beating the US dollar. It's beating the stock market, and yes, it's beating Bitcoin. In that period of time, actually, Bitcoin's down 14%. Gold has climbed 6% in the month.
I want to make sure that we heard you correctly. What did you say?
Gold is beating everything.
Including Bitcoin?
Including Bitcoin.
Okay. Because we've had a lot of questions about Bitcoin, and we could try to get into details about it, but we're not going to right now. I think the point of this is that we've had 4 interest rate hikes and 4 gold price rises right after that.
That's right. As you
I'd call that a trend, right?
Mm-hmm. Yep.
We've been talking about this, and I think it's going to continue. So we're in this period of time with the metals market where if you back up about a month, if you go listen to our show around the first part of December, we said this was your opportunity. Well, here we are $50-$70 higher. I think gold has wind behind the sails. I think it's going to continue higher. This last little respite here, about 1320 on gold, this little pullback may be all you're going to see. It might be it before we go up to the 1400s. I think gold has at least another $100 in the move before we see any type of, figuring out from there.
Yeah, Miles, commonly known as our chart man. Go.
Thanks, Tori. I'll assemble my mighty list of charts, starting off with gold here, which there isn't a ton to say. We saw a push up into the 1320s last week. I think we're all kind of hoping for that pullback to like 1310-ish, which we kind of saw yesterday.
Yeah.
Tuesday, 1312, 1311, I think we got down to. I'd have loved to see it a little bit lower, but if we're just going to hold here, we're going to keep going. So 1340, 1345 is probably our next stopping point, followed by last year's highs in the 1370s, as Robert suggested last week. And from that point on, it's off to the races.
Yeah, like I said last week, I'm really interested to see where the markets go from here. I think gold's at a crucial point. I think it's going to rise, continue to rise, but I think also the other two playing factors in this gold price are the euro and the dollar. And I'm really interested to see where the dollar breaks from here, whether up or down. It's at a crucial point. The world can't stand Trump. So, a weaker dollar wouldn't surprise me, but because everybody seems to be expecting that, I wouldn't be also surprised by the dollar rallying from here. So I'm really interested to see. I don't think we have a clear definition of where the dollar is going yet. And corresponding to that, gold, but I do think gold has a bit of wind behind its sails here, like I said before.
I do too, and it doesn't have to be counter to the U.S. dollar. The U.S. dollar is actually up from last week's show, so is gold. Miles, we actually did see your 1310 hit, and so to me, your level of support is still actually accurate. So to see the upside move, I hope we do reach that level of now new resistance at that 1340, 1345 mark. But it's not just gold that's showing strength. We're seeing commodity strength across the board. Copper up, oil up, the white metals up, right? Both platinum and palladium are showing strength. So what is that indicating?
In fact, I think Citigroup came out with a report stating they expected oil to come up to 80.
At least at some point in 2018. And the reason they're calling for that is geopolitical pressures. I'm not sure that that's what we're seeing right now, though, with commodities across the board. What do you think, Robert?
I don't necessarily believe Citigroup's predictions about anything. I think they basically put their momentum chart on and think that it's going that direction. I'm not that bullish on oil, but, I don't really trade oil, so I'm not the expert, but just a comment about Citi.
No, and it is a worthy comment. Oil at 63, though, is absolutely encouraging to the oil and gas industry. I just am thinking that it's an indication or a barometer of some potential equities markets downturns. Earnings reports are set to dominate that market focus this week, and Bloomberg's got articles on that. And then we also have the fact that, these increased equities markets prices are really spelling trouble for the stock market. In the first quarter of the year, just like we saw last year, it wouldn't surprise me to see the markets get some downward movement. And we have the pace of revisions to U.S. profit estimates at the highest in 10 years. And that's what's really happening. And I think that we will see the equities turn down, and the commodities are just telling us it's about to happen.
Yeah, some of the well-known names out there are saying that the equities market's not going to do well this year. And a couple of other well-known names, Gross and Gundlach, are also saying that bonds have turned bearish. And I think that's the big story this week. There's an article that we posted on our website, McAlvanyICA.com. We're going to have recent news postings on there, so I'd direct you to that. But today's articles that just filtered into the market was the idea that China was talking about slowing, stalling, or stopping purchases of U.S. Treasuries. Well, the article that I saw didn't have a source to it. So you think, well, always consider the source. Well, what's the source? It said people familiar with the matter, but it didn't have any author on the article.
Any names
no author,
listed?
No names listed. And I mean, I could make fun of that idea for a long time, because nobody should actually trust anything that's out there that doesn't have an actual source to it. But beyond that, that is a real threat. The U.S. government debt market is enormous. It's the largest in the world, $14.5 trillion. And we've talked about how much a trillion is. You could make $1 million a day since the time of Jesus' death and still not have $1 trillion. So forget that. But it's a huge market. I think the treasuries were already selling off. I think this article was just for the algorithm traders. Just post it out there, no source, nobody actually, claiming responsibility for it, just so that the computers could trade off of the headline of the article. Well, you could also argue that the treasury market has actually been somewhat bearish since July 2016, because the 10-year yield was 1.4. in July 2016, because it bottomed at the yield. Okay, so bond prices act inversely to the yield. Well, now we have a yield today on the 10-year of over 2.5. So you've had this enormous move already with yields rising on the 10-year.
Almost doubling.
And so you could already say that the bond market is somewhat in the initial phases of a bear market or in bear market territory. So you've got two guys, the king of bonds used to be Bill Gross, and then Gundlach. I mean, they're saying that this is the start of it.
And we are at a 10-month high in terms of those 10-year U.S. Treasury yields. That's not necessarily a major breakthrough yet. However, we've talked on this show, and we mentioned this in 2017, the average bull market in the bond markets lasts about 25 years. We're entering our 32nd year of this bond market, bull market. I love the argument that technically we're probably actually in a bear market, just early stages. I tend to agree.
Yeah, and exactly what you're saying, with 25 years being the length. Well, what happened, 7-8 years ago? We had a new paradigm shift with central banks, with the Federal Reserve starting it by doing exactly what the German bank did back in the Weimar Republic, which was print their own money to buy their own debt. That was the buyer of last resorts that came in, the Fed. Then when they started scaling down their quantitative easing programs, they handed the baton to the European Central Bank, and they started doing it. And then you've had the Bank of Japan, and these central banks are who are buying this debt. If you didn't have that stimulus into the bond market, who would be buying? And if China decides to stop or slow or even go the other way and go a net seller of U.S. debt, if China does that, who's the buyer?
Well, supporting your argument, the buyer is the central bank, right? So we see the Federal Reserve's balance sheet go from $1 trillion to $4 trillion. There is your buyer.
Sure. And so therefore you could say that at the end of the 25 years of the bond market, up until, 07, 08, 09, I guess they started the program in 09, you could say that was normal. Since then, since we've had this QE program, these QE programs, that's abnormal. So you can say we are not in a normal environment right now.
That's right. And they're painting over the fact that we're in a bear market in the bonds.
Correct. So any central bank could come out and say, well, I'm just going to print a bunch of money and then go and buy U.S. debt to support the problem. We still have the problem. You can't deny that there's a problem if they continue down this path, it ultimately ends in hyperinflation, right? The history tells us that. So anyway, I get really jazzed about that topic because it's just so ridiculous how unfair the bond market is when you have central banks printing money that didn't exist before to buy that debt and support the market.
That's right. Well, let's not forget about the white metals, Miles, touching on silver, platinum, and palladium.
Well, I think gold acting as the barometer it does, moving up and down with the U.S. dollar, with the equities markets, with a little bit of uncertainty out of the Asian markets. The white metals, on the other hand, haven't done a lot in the last week or two. You know, we've been preaching platinum and palladium for a while now. Silver's still holding at around $17. I think that gold is getting a lot of the attention because of some of the external pressures outside of the precious metals market. And again, I'm just going to keep saying it till it happens. I think when the white metals do turn and play catch up, especially silver and to some extent platinum, I think we're all going to be happy we own some.
Oh, I totally agree. And we are still seeing, you know, platinum is up $50 during that same period of time since the Fed raised rates. Palladium's up over $100. I mean, we crossed the $1,100 threshold in palladium. That blows my mind. That being said, we're still on the platinum side personally in terms of a recommendation.
So that's going to do it for Golden Rule Radio this week. Thank you for tuning in. As always, if you liked what you heard, hit that subscribe button below. Smash that little bell icon so you get a notification every week when we pop up. You can always contact us via our website, McAlvanyICA.com, on Twitter @ICAGold, or call us at 1-800-525-9556.
Thanks for listening. Have a great week.